Today's lecture is for the class of MCOM Part 1 in Government College of Commerce Sahiwal. In MCOM Part 1, we discuss about the subject of corporate accounting, and in corporate accounting we choose a topic of long-term liabilities. That is the chapter number 14 in our course book. So liabilities basically are of two types: current liabilities and long term liabilities. Basically, the liability we mean the future obligations or some future sacrifices of economic benefits arising from some present or past transactions. So these are payable in future. These are called as liabilities. If liability is payable within 1 year or within the current period, such liabilities are called as current liabilities. But if payment period is more than 1 year, the liability will be a long-term liabilities. Long-term liabilities are maybe a many types for the corporation. One basic type of long-term liability is the bonds payable or debentures, and then maybe a long-term note payable, long-term note payables. It may be a mortgage loans, long-term liability may be in terms of long-term pension fund obligations, pension fund obligations, and that may be some sort of off balance sheet financing like these liabilities and so on. But today's lecture is specifically is about bonds payable. So here our basic emphasis is on bonds payable. Bonds payable are debentures which only can be issued by the corporation to the general public against borrowed money from the general public, and it contains, it stated all the terms and conditions which are agreed between the company and the other parties. So as we said, from long-term liabilities, our focus is on bonds payable which can be issued by the corporation. So corporation issued the bonds to the general public against the borrowed money from general public and containing all the terms and conditions. So bonds payable have a different topic relating with it. Number one, issuance of bonds. Issuance of bonds, all the issues, all the matters, all the accounting relating with the issues of bonds we discussed in this lecture. And second topic was about payment of interest. Payment of interest, plus we have to discuss the amortization of discount and premium. And third one topic is retirement or redemption of bonds. Retirement or redemption of bonds. So these are three main topics relating with the bonds payable. So when we say the issuance of bonds, when we issued the bonds, so issuance of bonds payable, bonds may be issued at par, at premium, at discount. So there are three possibilities of issuance of bonds. Bond issued may be issued at par, may be issued at premium, and may be issued at a discount. There are three possibilities relating with the issuance of bonds, and these three possibilities are not, you may say, are normal, but it depends upon the following 2 or 3 factors. First factor is the coupon rate or bond rate which is guaranteed by the corporation for payment in terms of interest, and at the same time the rate which is prevailing in the market, that may be called as a effective rate, or that may be called as a market rate, or that may be called as a required rate. What name can be used for this? So what one rate which is available in the market and one rate that is available on our specific bonds payable. So one rate, 1% of interest which company have to pay on its bonds, and one interest rate which is prevailing in the market as named as effective rate, market rate, bank rate, effective rate, etc. So these two rates with their price mechanism, with the marketing mechanism, determine the price of the bonds. If these two rates are equal, it means bonds rate and required rate are the same, market rate and the bond rate are the same, then bond will be issued at a par. It means bond will be issued at par if bond rate is equal to market rate. But if bond rate, it means our rate, the coupon rate is more than the required rate, more than the market rate, it means our demand will be increased because we are paying more interest as compared to the market, then bond will be issued at a premium. It means bond will be issued at a premium. And third price mechanism, if coupon rate is less than the market rate, it means we are paying less to the investor as compared to the market, it means decrease in the demand and bond will be issued at a discount. So the mechanism of coupon rate and market rate can determine the issuance of bonds either at par, at premium or at a discount. And there are 2-3 other issues relating with the bond issue. There may be some bond issue cost. Bonds issue costs which are relating with the issuance of bonds. These costs may be in terms of printing costs, some kind of fee, some kind of brokerage fee, some kind of advertising other fee, bank commission, brokerage. So these costs once in a while in the whole life of bonds we have to bear in the bonds. So bonds payable have different things when issued. It have its some par value, it's have one is bond interest rate, it's have a specific life, and it's also have a dates of interest. Dates of interest. It means date of interest are also predetermined, and you may say mentioned in the bonds. Either we pay the interest annual basis, or either we are paying the interest on semi-annual basis or on quarterly basis. So all these terms and conditions will be written on the bonds. So now we discuss about the topic of, from all the topics we are discussing about bonds, we learn basics of the bonds. Then now we again focusing on issuance of bonds. Issuance of bonds. We are now specifically discussing about bonds. We are specifically discussing about bonds issuance. When we issued the bonds, we have a simple accounting entry. Cash will be debited with its issue price or with its market price or with the you may say what we received from the issuance of bonds, and bonds payable with its bond interest rate will be credited. If difference on the debit side, it means bonds are issued at discount, then discount will be debited, discount on issue of bonds. If bonds are issued on premium, then premium on bonds will be credited. It means there may be a discount or there may be a premium. Both things you may say not exist. One may be there, there may be a discount or there may be a premium. So one basic entry, cash will be debited and bonds payable will be credited. Bonds will be credited with its par value and cash will be debited at issue price difference. If on the debit side, it means bonds are issued at discount less than par, but if difference on the credit side, it means bonds are issued at more than par, then it will be a premium. So this was all about bonds issuance. But if we incur different kinds of bond issue costs, then bond issue cost will be debited. Bond issue costs will be debited and cash will be credited. What actually we paid for the expenses or costs relating directly with the issuance of bonds. So we have a entries for issuance of bonds. We make entry cash, debit, bonds, payable, credit. Now we are moving towards another topic, that was a payment of interest and also amortization of discount or premium. So we have to amortize the discount or premium. As we earlier said, bond issuance has three types. Bond may be issued at par, bond may be issued at premium, or bond may be issued at discount. If issued at par, then no premium, no discount, no amortization. But in case bonds are issued at discount, we have to amortize the discount. And if we have a premium in our issuance of bonds, then we have to amortize the premium. First of all, we learn the entry for payment of interest. What entry we have to make for the payment of interest on periodic basis. On periodic basis. One thing, that is, if we flow diagram or timeline regarding the bonds, that is very basic thing relating with the accounting and finance. When we issued the bonds, for example, bonds are now issued now today, but bonds have a life of 5 years. So what we receive today, that is our cash flow inflows. For example, we receive 1100, but we have to pay the interest at the end of every year. For example, we have a par of 1000 and interest rate is 10%. It means at the end of every year we have to pay 100 in terms of interest, and at the end of 5th year we have to pay interest plus we have to pay the principal. So this is all about regarding the, you may say, a flow diagram or timeline regarding with the bond issues. Okay, how cash are flowed. We received amount today when we issued the bonds. We have to pay the interest at the end of every period. We have to pay the interest if we are paying annually. If we are paying semi-annually and quarterly, then our timeline shows more interest payments, and at the maturity, at the time of maturity, at the end of bond's life, we have to pay the interest and we also have to pay the principal. So this is also the mechanism of calculating the price. If we want to calculate the price, we calculate the price in this formula. B naught is equal to interest into present value interest factor of annuity plus par into present value interest factor simple. It means this may be further calculated. Present value interest factor of annuity may be calculated with the formula of 1 minus 1 over 1 plus I raised power n whole divided by I. But simple factor can be calculated with the formula of 1 over 1 plus I raised power n. So this is the price formula or price mechanism to calculate the price of bonds. But now we are discussing about the price. After discussing the price, now we want to discuss the payment of interest. When we pay the interest, we have a simple entry: interest expense debit cash account credit. So cash is the basic amount which we have to pay. That is paid on par and bond interest rate, coupon rate, multiply with number of months divided by 12 if paid periodically, and period is less than 1 year, then we have to multiply it by divided by month over 12. If payment is made for the whole year, then it is enough to multiply the par with the bond interest rate. But second thing, we have to not only make the payment of interest, but we also have to amortize the discount or premium. So amortization of discount or premium is also the issue that is relating with the payment of interest. So now we make the entry, that combine entry making the interest plus we have to amortize the discount or premium.